Imagine spotting high-probability bullish reversals that deliver clean multi-time frame confluences straight from daily order blocks to precise lower time frame entries. But most traders keep failing here. They chase every rally or ignore the deeper inefficiency layers, leading to false breakouts and consistent losses. The hidden truth is that smart money uses wicks as classified gaps and specific mitigation mechanics to trap offside positions before resuming the true institutional direction. If you're still treating order blocks and fair value gaps as simple support without understanding mitigation and breaker logic, you're missing the algorithm's real playbook every session. By the end of this video, you'll fully grasp the complete multi-time frame order block to mitigation framework for spotting and trading these institutional bullish setups with total precision. Look at this daily chart where the old high and consequent encroachment set the stage. Let's get started. Take your focus up to this daily chart. Notice that old high right here. Then consider the consequent encroachment of that wick, because in ICT concepts, wicks are classified as gaps. Look at this chart closely. ICT order block theory and gap theory are separate. They share similarities in certain aspects but differ significantly in others. Right here, we see two down close candles forming the bullish order block. If you examine from this candle's high to this candle's low, that creates a buy-side imbalance. Sell-side inefficiency, specifically a fair value gap categorized as buy-side imbalance, sell-side inefficiency. The market trades down into it here. It reaches the order block from the open to the high, so pay attention to both levels. Be mindful of this imbalance area from here to here on that single candle. And the order block itself consists of these two candles. It appears we traded lower here, collected discount, pulled away from the low, and are likely heading up toward this level. Now switching to the hourly chart, right away, you should direct attention to this key level. That is these relative equal lows, combined with the daily PD array right here. It targets this range from here to here, the order block high and the open on the daily chart. Those are exactly what these levels represent. You can see how price ran higher, took out the short-term high, then broke lower. We get a high, low, higher high, followed by a down close candle. What does that become? A bearish breaker. It trades below, comes back up, bumps it, then sells off aggressively. It continues selling to sweep the sell side liquidity. And notice an imbalance here and another one here. We are going to examine both closely. Here is the 15-minute time frame. The chart appears very clean here. Too smooth jagged edges often result from institutional activity. Smooth edges tend to get turned jagged. There is a fair value gap here. Market trades down into that zone, comes back up, finds support, rallies through the short-term high, then trades up into the imbalance here because of this balanced price range that it must overcome. Now on this 15-minute time frame with the imbalance visible, we have sell side and the fair value gap. It digs down into that area. It also hits the lower and the sensitive price point of a bullish order block, which is the opening price and the high. It trades into it, touches it, then reacts strongly. So let us zoom closer inside this zone. Dropping to the 2-minute chart. Why the 2-minute? To save time while capturing all the fine details you would normally scroll through anyway. We see buy side here, smooth relative equal highs. It breaks the order block, trades back to it, sells off, reaches our imbalance, digs into the lower end, which is the opening price on the down close candle from the daily chart, marking the bullish order block. This is the high of the daily bullish order block. Go back through this video a few times if needed. I promise it stays focused. But this level is the opening price on that daily down candle we discussed at the start. We trade down into it, sweeping sell side here, then move higher. Then trade back down into a fair value gap. After sell side gets taken and a higher time frame order block is reached, the market rallies and trades above a short-term high. This is exactly what to watch for. We have a shift in market structure, fair value gap here. Trades down into consequent encroachment between the candles low and high. Midpoint sits here, and we have a bullish breaker. Low highs and lower lows. Take the body of the candle, the most upper one, extend it forward. You do this with the up close candle, not the down close, when working bullish breakers. Extend it through. You can see support forming in here. Consequent encroachment, and you want gaps like that to remain open. It supports the possibility of a breakaway gap. Market rallies back up into the last up close candle. This qualifies as a breaker by standard definition. But because we are extended from that high, it keeps stretching further when we trade back to it and above. It becomes mitigation. So what is being mitigated? Any trader who was offside going long in here can mitigate that position here. Order blocks and candles do not mitigate according to ICT. I see many people overuse that term. Remember, mitigation is the trader's action when offside. Order blocks and candles do not mitigate anything. Price provides the opportunity for the trader to mitigate their offside trade, reducing or eliminating drawdown. There is also buy-side imbalance, sell-side efficiency from this candle's high to this candle's low. We dip partially into it. It holds as support. Why not all the way to this level? The mitigation block leaves some inefficiency open. Expect institutional order entry, a partial fill into the fair value gap before resuming higher. The market pushes up into buy-side to reach here, creates a bullish order block, trades down to here, rallies, consolidates, accumulates more longs, then rallies away. What level is accumulation happening at? The high of the daily bullish order block wick down here is the daily order block opening price. So this is the high wick area. Then market rallies, retests the order block here, and continues higher. That's it, traders. Thank you for watching. I hope this explanation delivered greater clarity and practical insight that you can apply to your own trading. Make sure to subscribe and turn on notifications so you never miss future content. Leave your questions and suggestions in the comments section below. Let us know which topics you would like to see covered next. We truly appreciate your support, and we look forward to seeing you in the next episode.